Hello friends, today we are going to learn the basic concepts of accounting. Let's move on to what is accounting. Accounting is the systematic way of identifying, recording, analyzing and classifying the transactions, and the transaction is an activity that a business or a person generates. If a business pays someone to the supplier to get the product, it is a transaction. For example, in an online market, Amazon, there are three transactions. Once the customer places the order and buys things from the Amazon, Amazon settles the transaction with the bank to get the money paid by the customer on credit card. Number third, Amazon pays to the supplier to get the product and deducts commission on the sale. We have an exercise number 1. John decided to start a business with $1,000 and purchased a laptop worth $250 for it. He gave advance of $400 for the renovation of the new office, having rent of $50 per month. How many transactions were executed by the John? Two transactions were executed by the John. Once he purchased a laptop worth $250 and he paid advance for the renovation of the office amounting to $400. Total transaction amount is the $650. One of the basic concepts of accounting is the chart of accounts. Accounting has 5 pillars: ALCEI: assets, liabilities, capital, expenses, income. ALCEI. Just to remember it, it is not an official abridged version. It is a way of remembering the difficult thing in your mind. ALCEI: assets, liabilities, income, capital, and expenses. Moving on to the asset, anything which has economic value and could be converted to the cash is an asset. Asset for a business. Focus on two things. Once it has an economic value, and the other it could be converted into cash. For example, real estate, property, car, house, laptop, machinery, plant, anything having economic value and could be converted to cash is an asset. For example, for a roadside coffee shop, we have two assets. The main one is its whole structure, and the other one is the cash. Liability is an obligation of the business generated in the course of operations. A business transfers the asset to another creditor to settle its liability because the asset has its own economic value and it has the power to settle the liability. In short, these are payables by the business. Capital is the most important element of the business. It is the money contributed by the owners into the business. It is a form of the liability, but to keep it separate from the business liability, it is renamed as capital. Expenses: the amount which is used by the business to generate the income. For example, salaries of the employees, utility and electrical bills, rentals, any day-to-day expenses which are necessary to generate the business or to conduct the business. Income, the most exciting element of the business, is the income. Every business is conducted to generate an income or the revenue. Income is the inflow or the cash incoming to the business out of the sale of the goods or the services. Let's have an idea of the exercise number 2. Elements of the accounts. John's business is now getting better. He hired 3 staff members having salary of $300 per month and earning $1,500 per month. After initial contribution is given in exercise number 1, John contributed only $100. His banker has confirmed the cash of $650 in his bank account, out of which he has issued checks of $450 to Simpsons, one of his suppliers. The total amount of capital contributed by the John is 650 till exercise number 1 and 100 additional capital, totaling to the $750. Assets. His banker has confirmed the cash of $650 and a laptop of $250 purchased by the John at the time of starting the business, totaling 650 plus 250 900.